Equity markets have wobbled in January. That has some concern who track seasonality because the saying goes, as January goes, so goes the rest of the year. Our next investor has been in the markets for quite some time, and he has a different view of how 2024 is going to play out. He thinks there's going to be great returns both in the U.S. but also in Canada. Let's bring in Ken Fisher, Executive Chair and Co-Chief Investment Officer at Fisher Investments. Ken, thank you so much for being with us. There's a bit of consternation, as I mentioned, about what 2024 has in store. Your outlook, though, is bullish. Talk to us about why that is.
Well, first, thanks for having me, Amber. It's nice to see you. It's been a couple of years now. The fact is, first, all of the things that people talk about, higher rates longer, wars, a potential hard landing versus soft landing, what'll the Fed do, that stuff's what markets pre-price for a living. And bull markets climb a wall of worry, and these are just bricks in that wall. The fact is, I'm just going to make a couple simple points. One, we got an election year coming up. When I was with you in 2022, I talked to you about the power of upcoming gridlock from the 2022 elections. But presidential elections are positive in the United States, 83% of all years since 1925 when accurate data start, with 11% average returns. A secret that I've made a point about pounding the table on, including in my December 22nd Globe and Mail column, is that whenever in that history there's been a second year of a president's term, like 2022 was, that was negative. The fourth year, the election year, like 2024, has been positive every single time since the bottom of the Great Depression.
Let's talk about where that trend could falter, a recession. Are you worried about that prospect? I struggle to reconcile how can we be pricing in, 150 basis points of cuts and a soft landing?
So let me be clear on that. Rate cuts have nothing to do with anything important as it relates to stocks. If they did, or rate hikes, if they did, think about it simple. People don't want to believe this, but it's true. When I was with you last time in the summer of 2022, we've seen one heck of a lot of rate hikes, and big ones and repetitive ones since then through into last year, while from June in Canada and on in, you've seen markets rising. How do you put that together? The fact is, if you go back and do correlations, there isn't one. This is a cultural myth people have believed for a long time. Central banks don't have the power people think they have.
I guess the chief complaint of the market rally yesterday was that it was narrow in concentration, that it was just those tech stocks and rate-sensitive sectors did underperform.
So when you go day to day, you of course get volatility, and stuff happens, and that's part of the nature of bull and bear markets, to try to knock people off and give them the wrong direction. But all last year in 2023, people complained about the narrowing market as it was led ever more by big, high-quality growth, mainly tech, but also outside of tech, things like consumer luxury. And yet it persists. And it persists particularly because when you have a very low growth global environment like we have, the companies that can grow in a low growth environment achieve a super premium because they're very rare, they're very unique, and the ones you can actually rely on in that regard build a premium. When you get to what I think will happen later in the year, which is we will get rate cuts, the yield curve will start to stop being inverted and start to become normally more steep. That stimulates bank lending, and as it stimulates bank lending, that ripples pretty quickly into value stocks leading, which would include the industrials and the materials, and so much of what actually is, and financials as well, which is so much of what is centralized to Canada and the TSX.
So that's interesting. As you call for the continuation of a rally in 24, it sounds like you're also calling for a change up in leadership. value to
Yes.
outperform, which it has been doing the last couple of months.
But be careful, because I do believe that until we get, like you take today, tech is doing better. This week, overall, tech is doing better. I think we start off seeing tech doing better, and then we see rotation into value away from growth. I do not think that the growth movement is over yet.
You mentioned the election year and how it pertains to the U.S. stocks for Canadian investors. Is this something for them to pay attention to? Does it also get caught up?
Absolutely. Let me go back and make 2 points. First, the U.S. and Canadian market over the long term has a 0.81 correlation, where 1.0 would be moving in lockstep and negative 1.0 would be exact reverse lockstep. There's a pretty high correlation. Secondly, in those same presidential election years, 77% of them have been positive. The fact of the matter is this positivity spreads not just to Canada, it actually spreads off into Australia, it spreads to Britain, every country slightly differently, but positively in all of these. It's a global bull market.
When you're talking the Canadian markets, and I hear your point about tech, which we don't have as much of on an index basis. It's less than 9% of our index. You have to be positive about, kind of 2 of 3 things: out of financials, energy, and materials. Do you have a view of any of those sectors that confirm your bullish bias there?
Let me restate what I said earlier. I do believe later in the year, as inflation everywhere continues to moderate, and as the central banks get to the point where they can claim victory, hallelujah, then at that point in time, we'll see rate cuts, which will make the yield curve less steep, more in its normal form. The core business of banking is taking short-term deposits as the basis for making long-term loans. And as that environment occurs, banks become more eager and aggressive as lenders. As they do that, it helps the value stocks, because value stocks, being more economically sensitive and overall with weaker balance sheets than big high-quality growth, are much more bank loan dependent. And as they start getting the bank lending aggressiveness, it's just like putting more slop in the little piggies trough, so the little piggies don't get pushed out of the way by the big piggies.
Well, it's interesting you're talking about value, because that was going to be my next question. When you look at market valuation, we certainly are towards the higher end. Does that kind of filter into your thinking about why you should now is a good opportunity to be looking at those lower value names?
Let me say this. No one ever wants to believe this, because we all derive from earlier, more primitive primates, which right into us evolutionally in terms of evolutionary psychology, fear of heights. But the fact of the matter is, and I've done this work over and over again, I've written about it so many times, I did it heavily in my Only 3 Questions book, a whole chapter on it. There is actually no correlation in any time frame that people actually care about, like 1, 3, 5 years, between valuations and future market activity. Valuations are not predictive in any time period. Yes, in the very long term, they're predictive. In 1, 3, and 5 year periods, they're not.
I like that analysis, because often we hear that as a complaint for certain high-tech stocks that just continue to defy expectations. How then do you look at these names that seem insane compared to traditional valuation metrics that you are taught in other textbooks?
So behavioral psychology actually teaches us that most of us are mentally depressed. But be that as it may, the fact of the matter is the way you look at it is A, sentiment, and B, what is most rare and underappreciated. In a period where people say they can't go up because the PEs are too high, if everybody says that, it's priced. Secondarily, in a world where growth rates are very, very low, the companies that can actually reliably grow become exceptionally valuable on a temporary basis. It's when everybody can grow because the economy's so strong that premium goes away.
Because you are such a market historian and you've been in the markets for so long, I'm curious what you think about the relatively new kid on the block that is Bitcoin.
Oh, I don't know. This is a little outside my realm of expertise or desire. Let me just say it's inherently volatile. A point that most people don't think through, which I think through all the time, is one of the things I always think about is correlation. And Bitcoin correlates positively with the stock market. Therefore, it's a lot like a big single high volatility stock. In that regard, it's not really, it's more of a speculation than it is an investment. And while I do believe you can think of every single stock as a speculation or an investment, I think with Bitcoin, you mostly think of it as a speculation.
Before I let you go, you've laid out your case quite eloquently. How do you think about the risks to your base case as you stress test your view, where you might get it wrong?
Oh, let me just say before I answer that in the realm of endeavor in which I operate, if you are right more than 70% of the time, in the long run, you become eventually a living legend. And the fact of the matter is that means you're going to be wrong, and you better be comfortable being wrong 30% of the time at least. It's like a boxer. You're going to get hit. And it's how you survive the getting hit that makes the difference and makes whether you can come back and be good. The fact of the matter is markets pre-price all widely known information. It is such a basic concept of finance theory, most people can't accept it in their bones. They think their opinions about things override everything else. What will blow this market out of the water is a big bad thing that I can envision. Now, let me add one more point. John Templeton, legendary Canadian background, famously said, bull markets are born on pessimism, grow on skepticism, mature on optimism, die on euphoria. We're bouncing around someplace between skepticism and optimism right now. And it takes a long time to get through optimism and into euphoria, where the bull market would die its natural death. But when a bull market gets to 1 year old, it almost always gets a second anniversary. And unless some big bad thing comes along, big bad, that nobody's talking about, enough to take down global GDP, because stocks fall before recessions happen. Going back to your earlier question, the bull market will keep going on. It'll just trudge and it'll be progressive.